So, you just opened your TFSA account? Congratulations! You're already ahead of most Canadians. But now you're staring at this empty account thinking, what do I do with it? Do I just transfer money in? Do I invest? If so, in what? This was us when we first opened our TFSA. So, if you're confused, you're not alone. Because the TFSA is actually one of the most misunderstood accounts in Canada. So today, we are sharing what we actually invest in our TFSA, why we chose it, and how you can build a simple, effective TFSA strategy. No jargon, no complicated theories, just what actually works. Welcome back to 2 Cents Diaries. Let's get into it.
Quick recap. TFSA stands for Tax-Free Savings Account. Despite the name, it's not just a savings account. It's actually a special account where you can invest your money and grow it completely tax-free. Inside the TFSA, you can hold cash, stocks, bonds, ETFs, whatever you want. And any growth that happens, zero taxes. You make $10,000 in investment gains, tax-free. But you cannot just put unlimited amount of money in your TFSA. For 2026, you can contribute $7,000 in your TFSA. If you have never contributed before and you're over 18, you may have almost $109,000 available in your TFSA contribution room. Check your CRMI account to know your exact limit. Now, here's the biggest mistake people make. They open a TFSA, they contribute some money in, and just leave it there sitting as cash, basically earning nothing. If you're earning 1% interest rate on $10,000, you're earning just $100 per year. But if you invest that same $10,000 in an ETF that tracks the stock market, you could potentially earn 7 to 10% return. That's $700 to $1,000 per year, completely tax-free. Over 20-30 years, that's tens of thousands of dollars of lost growth if you just keep it as cash. If you're saving for something that's 5, 10, or 20 years away, like your retirement, financial independence, long-term wealth, you should be investing in your TFSA, not just saving in it. Now, you may ask, what should you invest in?
You could pick individual stocks, Apple, Tesla, whatever. But we don't recommend that. Individual stocks are risky. You're betting on one company. Instead, we invest in ETFs, exchange-traded funds. An ETF is like a basket holding hundreds or thousands of stocks. Instant diversification. For our TFSA, we focus on 3 simple all-in-one ETFs: XEQT, XGRO, and XBAL. XEQT is 100% stocks. Over 9,000 companies from around the entire world. Apple, Microsoft, Amazon, TD Bank, Shopify, all in one purchase. We personally invest in XEQT because we are young, have decades before retirement, and want maximum growth potential. But XEQT is volatile. Some years it might go up 20%, other years it might drop 15%. If that kind of swing scares you, then XEQT might not be for you. Option 2, XGRO. It's 80% stocks and 20% bonds. Stocks give you growth, but they are risky. Bonds are much more stable, but slower growth. By mixing 80-20, you get strong growth with less volatility. XGRO is great if you're 10 to 20 years from needing the money, or if you just want a bit less stress. Option 3, XBAL. It's 60% stocks and 40% bonds. Most conservative of the 3. You are trading some growth potential for more stability and peace of mind. Ideal if you are closer to retirement, maybe 5 to 10 years away, or if you really don't like seeing your account balance swing around. So to recap, XEQT, maximum growth, maximum volatility. XGRO, balanced growth, smoother ride. XBAL, conservative but stable. So, which one should you choose? And hey, if you find this helpful, hit that subscribe button. We post videos like this every 2 weeks to help you navigate money in Canada. Also, quick but important note, everything in this video is for educational purposes only. We are sharing what worked for us, but your situation is unique. Before making any financial decisions, please talk to a licensed financial advisor. Now let's get back to the topic.
Choosing between XEQT, XGRO, and XBAL comes down to your time horizon and risk tolerance. Time horizon. How long until you need this money? 20 plus years? Go for XEQT. You have time to ride out the market crashes and benefit from maximum growth. 10 to 15 years? XGRO. You still want growth, but you're getting closer to when you might need the money. 5 to 10 years or already retired? Go for XBAL. XBAL stability is valuable. Risk tolerance. Can you handle seeing your account drop 20% without panic selling? If yes, then XEQT is your answer. If that stresses you out, XGRO or XBAL might help you sleep better. Here's the beauty. These ETFs automatically rebalance themselves. If you pick XGRO, it will always maintain that 80-20 ratio. You don't have to do anything. Just buy it and hold it for years. And honestly, you can't go wrong with any of them. The most important thing is to just start investing. Don't try to time the market or overthink it. We personally use XEQT in our TFSA because we're in our early 30s and we're comfortable with the volatility. But your situation might be different, and that's completely okay. Just choose what works best for you.
Mistake 1. Over-contributing. If you exceed your limit, you get hit with 1% penalty per month on the excess. Always check your contribution room on CRMI account before contributing. Mistake 2. Day trading. Some people try to trade stocks constantly in their TFSA. CRA can flag you and might consider it business income, which means you lose the tax-free status. The TFSA is for investing, not active trading. Buy and hold.
Mistake 3. Panic selling. When the market drops, you see your balance go down and you panic sell everything. This is how you lock in your losses and miss the recovery. If you're invested in XEQT for the long term, short-term drops don't matter. Markets always recover. For example, in 2022, XEQT dropped by almost 11%. If someone had panicked and sold everything they had, they would have missed out on the all-time high returns we are getting now. And finally, mistake 4. Not investing at all. I think this is the biggest one. You have this incredible tax-free savings account and you just don't use it? Or you just keep your money sitting there as cash? Don't let fear stop you. Even $50 per month into XEQT is infinitely better than doing nothing. Here's exactly what you need to do after watching this video. Step 1. Check your CRMI account for your available contribution room. Step 2. Decide your time horizon and risk tolerance. 20+ years and you can handle volatility? Just buy XEQT. Want more balance? XGRO. And stability? XBAL. Step 3. Open a TFSA investing account if you don't have one yet. Personally, we use Wealthsimple. We're making a video on how we're using Wealthsimple for investing soon. Step 4. Set up automatic contributions. Even if it's just $50 or $100, just automate it. And finally, step 5. Just leave it alone. Don't check it every day. Don't panic when the market drops. Just hold. And let compounding growth do its thing. The TFSA is one of the best wealth building tools currently available in Canada. So use it wisely. If you like this video, drop a like and subscribe if you haven't already. Let us know in the comments below, what are you investing in your TFSA? In the meantime, watch this video where we explain what RRSP is and how you can maximize your RRSP to its full potential. Thanks for watching. We'll see you in the next one.